How did the wealthy get wealthy, and can I copy them? So in a recent video, I talked about who are the poor and wealthy and how do they get there. So today I'm going to focus on how the wealthy became wealthy and, can we just copy them and also become wealthy? Now, I've seen the full finances of thousands of Canadians and I've read many studies. So this is based mostly on what I've seen, but also what I've read. Now, I admit our clients are not representative of the public. They're generally higher income. They're much more growth focused, and they're always working with a financial plan. Not everybody, but this is the basic, profile of most of our clients. However, I have talked with so many people on the blog and in person, and I know many wealthy people, so I have a very good idea of who they are and how they achieved wealth. So what we're going to learn today is how much do you need to be wealthy? So what types of people have high net worth? What is a productive growth asset? That's an important term. Do you have to borrow to invest to become wealthy? What does life cycle investing study tell us about growing wealth? And how can you copy their methods and become wealthy? All right, so how much do you need to become wealthy? So it's a definition, like when are you there? So now, basically, the way I look at it is wealthy is having investments that will provide comfortably more than your desired lifestyle if you choose not to work. Okay, you don't have to worry about money. You always will have enough and more than enough. So now, having 20% more than your financial independence goal is what we call a margin of safety. So you have a financial plan that says that the way you want to retire to be financially independent, this is how much you need. 20% more is just a margin of safety. So let's say wealthy, your definition of wealthy is 50% or more ahead of that goal. Okay, so it's enough you don't have to worry about money. You'll always be able to live the lifestyle you want, and you have, a bunch more. So now, for most people, this is probably 2.5 to 5 million investments, excluding your home. Now, many people are higher or lower than that, but that's just kind of a sense of what, where it might be. So now, what types of people have a high net worth? So remember, wealthy is not a high income, it's a high net worth. So what kind of people have them? So for the most part, the wealthy are mostly just older people that saved and invested effectively through life. I know maybe some more complicated, but that's really who they are. So now, very few inherited it. So I looked at the Forbes 400 richest people, and it tells you how they got there. Only 13% inherited it. Almost all of them made it themselves. So, and most inheritances, when you get an inheritance, most people that get it are in their 60s or 70s. It's too late to grow it. And we've helped lots of people like plan for their retirement and stuff, and their future. And most people don't actually want to leave a massive inheritance for their kids. They more want, like, they've saved up a certain amount. They want to enjoy their life. Get the kids started a little bit, but most people don't want to leave a huge inheritance. So that's why you don't really see that very often. So now, almost nobody won it in the lottery. Now, I just said I have lots of jokes about the lottery and what the odds are, but almost nobody that's wealthy actually got it on the lottery. And the big problem there is people that win it never learn how to handle money, and then usually end up, frittering it. It fritters away on them. So it's not a way to get wealthy. So almost all millionaires and even the billionaires have made it all themselves. So now, wealthy people grow it through investments or a business. That's really how they get it. Just build it up over time. So now, high income is helpful, but it's not essential. So remember, it's not what you make, it's what you keep that matters. So now, high income, of course, makes it a lot easier to invest a lot if you have a high income. And the way to do that is you need to learn a valuable skill, something that employers will pay for or that you can build a company for. It's a valuable skill. Now, some university degrees, not all, will teach you a valuable skill, such as the STEM fields or IT or engineering or something. Also, sales, a lot of sales does it well, or trades, or, skill as an entrepreneur building a business. But so you need a valuable skill. That's what gets you a high income. Now, wealth builds with age. This is the main thing. If you want to become wealthy, it just tends to build with age. So, we have a chart here. We show you the wealthy are mostly older people, say 50 or over, who saved and invested over the years. That's really all it is. And you know what? That's actually really good news because, it means this is not super complicated. You can do this. Just save a good amount, invest for growth over the long term, let it compound, and you can become wealthy. It's not really, it's not rocket science. So now, what is a productive growth asset? So productive growth asset is what you need to be able to get there. So it's an asset with a good return that's reliable long-term, significantly higher return than inflation, and it's in assets that you will use for your lifestyle in the future. So not personal use. So if you look at, common assets. So inflation's averaged, maybe 3% the last 40 years. So real estate in Toronto's averaged about 6, but half of that's inflation. So 3% after inflation isn't that great. Stocks have, especially when you go to global and US, have averaged, 10 or 11, which is about, 7 or 8 after inflation. So that's, decent rate of return as a long-term return. So and you're trying to get something that's going to grow quite a bit over time. Now, the top 20% of people, not the top 1% in net worth, most of their net worth is in their house. Okay. Now, your house is not a productive growth asset. Okay. Unless you're going to use it for your retirement income in some way. Now, you could sell it and rent, or you could downsize to like a much lower cost home and get a sizable amount out and invest that amount. So that amount would count as part of your productive growth assets. So, or you could borrow against it to invest. We've had quite a few clients do Smith maneuver or various kinds of borrowing to invest against your home. Or you could borrow against your home to spend. Okay. But unless you do one of those, your home is a personal use asset. So it's, so you got to build your net worth of productive growth assets that exclude your home. Now, the wealthy are generally growth investors. So they invest in the stock market. We call it equity investors. Equity is the stock market, or they could be business owners. Or investors in leveraged real estate. And that means they have to always keep a large mortgage. So, when you see real estate returns are a lot lower than the stock market. So real estate with a large mortgage can be a good investment, but paid off rental properties are usually a low return and high tax. So not that effective. So if you have rental properties, the idea is to keep a high mortgage all the time. Now, equities, the stock market or businesses are the highest growth asset class. So, and whether you're a stock market investor or you own your own business, either way, you're investing in businesses, and that grow over time. So that is really the asset that has the highest long-term reliable growth. Now, I have a chart here that can show you the example of wealth, what's actually happened over the last 40 years, stocks versus bonds, fixed income, and versus real estate. So, you take the average house in Toronto in 1974, it was $52,800. That today is a little over $1 million. It would be about $825,000 if you were in fixed income like bonds or GICs, but it's almost $10 million in global stocks. So see, that's the difference. Instead of being invested in real estate or fixed income, it's the part of your investments that are in the stock market. Then a lot of people invest, balanced, so it's some growth, some defense, so some stocks, some bonds. It's really the stocks part of your portfolio that's the engine. That's what grows your wealth over time. Now, the stock market has been reliable in history over long periods of time, not short or medium, but if you're in for a long term, it tends to grow quite consistently. And it's because you're investing in businesses that tend to grow over the profits over time. And, it grows with, kind of similar to the way the profits of businesses grow over time. And so if you look at, chart, this is 25-year returns of the stock market. And you see it's basically always done giving you a good solid return. The worst ever has been 5% a year. That's way back. And in the modern stock market since about 1930, the worst 25-year return has been like 8% a year. This is U.S. market. So it's reliable, as a long-term investment. And that's why it's such an effective way to build your wealth. Now, basically, to build wealth, you just save and invest for growth for the long term. So now save a healthy amount, get a decent return on your investments. And, for long periods of time, like 30 years, you need to include inflation because you need the purchasing power to be able to afford your future lifestyle. Okay. Now, 1,000 a month, if you just look at some charts, I find a lot of people, when they just do their own calculation, they forget about inflation. So 1,000 a month can get you, 2 or 3 million over 30 years. However, after inflation, it's about, a million or a little under a million. Depending on how you define wealthy, that's probably not wealthy. Now, 2,500 a month, that's 30,000 a year, can get you about 2.5 to 5 million after inflation, which is kind of where most people, would define it as wealthy. So I'm giving you kind of a sense of what kind of number it would be. Now, 2,500 per month is just the RSP limit for people that have a higher income. So 70%, 170,000 or more. Or if you have, if you have a couple, that's, 1,250 per month for each of you, and so that can get you to 2.5 to 5 million after 30 years. That's 8% rate of return. So that's, something that's reasonable. I'm trying to give you a sense of what way to do it. But that, wouldn't be a super hard thing to do for most people. Now, do you have to borrow to invest to become wealthy? And the answer to that is no, because you can just save and invest for growth over the long term, and that alone could make you wealthy. Like the last example, just 2,500 a month for 30 years, and you're reasonably wealthy. So now, however, having said that, the highest net worth, the top 1% or 5%, whatever, the highest net worth people usually did significantly borrowing to invest. So nearly all of the very wealthy people borrowed to invest in investments or in their business. For example, people could do the Smith maneuver or some sort of investing against their home. They could just do an investment loan, like 3-for-1 loans are common for investors. But a lot of people that, people that start their own business, most of them are borrowed to build in their business. That tends to grow your business. A lot of businesses, you need some financing to be able to grow it. Or if you invest in real estate, again, you need, a high real estate with a huge mortgage on your real estate. You need that to make it a good rate of return. And then again, that's borrowing to invest. So, but that's what the really wealthy, almost all of them have done that. So here's just an example of how borrowing to invest can help. Let's say that you invest $4,167 a month for 30 years. That's $50,000 a year for 30 years. You put in your RSP or something, and so that builds up to about 5.9 million. That's a pretty good amount of money. That's probably what most people consider to be wealthy. Again, it'd be about half of that after inflation, but that's a pretty decent number. Now, let's say instead of that, as a comparison, you go out and borrow $1 million, okay, and invest it. Now, your interest payment on it would be about $4,167 a month. So it's the same payment, but instead of just starting with zero and investing bit by bit, you're putting a big chunk in at once, and you're just making interest payments on it. Okay, so the investments there would be almost 21 million, and the point is, you end up with 4 times of the investments with the same cash flow. And that's the difference that borrowing to invest can make. Again, you need to do it over the long term. It doesn't necessarily happen in the short term, because you could borrow to invest and it plunges. But if you do this over many years like this, the returns, the market has been pretty reliable. And then you can have significantly more if you borrow to invest rather than just, the old bit by bit. Now, what does the life cycle investing study tell us about growing wealth? So life cycle investing is a study by 2 Yale professors about saving for investment, for retirement, the same way you buy your home. Okay, so just go out and get a big loan and pay it off over time. So rather than just saving bit by bit. So now borrow as much as possible when you're young and pay it off by your mid-50s. That's kind of the concept. And move to your target asset allocation by retirement. So now you got to think of this not as something you literally do, but just as a concept, because it's got a valuable lesson in it. So now the study showed that 100% of the time, this has created more wealth than the normal bit by bit savings most people do. So it really works. It's worked always in history. Okay. Now it works because you start with a large investment portfolio when you're young. Normally if you start up, you only have a large portfolio when you're much older, and that it's large when you're young, and it compounds over a long period of time. Now, that's part of why it builds. But the reason that it's so consistent is because it reduces a really big risk called last decade risk. So last decade risk is what most people face. You invest a bit by bit over time, and your investments grow. And so if you invest over 40 years from age, let's say 25 to 65, and your investment returns are low in the last decade from age 55 to 65, then your 40-year return is low. Okay, you lose a little over half of your 40-year rate of return if you make nothing in the last decade. So, and it's because nearly all your investments are held in the last decade. So your rate of return the first decade from age 25 to 35 is almost irrelevant because you have hardly any investments then. So, the investments you have over the 40 years, you probably have about 2% of them in the first 10 years. And I find a lot of young investors, they're just so focused on getting a big rate of return. But you know what? A much more valuable thing, this is the conclusion from the study. So when you're young, having a large investment portfolio is what matters, much more than your rate of return. So if you borrow a significant to invest, even if you don't get as high a return, you're probably well ahead of somebody who starts with a very small amount and gets a good rate of return, but they've got hardly anything invested. So that's the wisdom from the life cycle investing study. So to build wealth, try to get as much money invested as possible when you're young and grow it for 40 years, even if you have to borrow it. So that's kind of the wisdom here. So now, this concept is not for everybody. It's only growth-focused people that want to focus on being wealthy, or, and people who will stay invested for the long term. But it's a good concept and a valuable lesson. So how can you become wealthy? So what we learn from this is basically the wealthy are mostly just older people that saved and invested effectively throughout their life. So that's really who the wealthy are. And that's not that complicated. So that's great news. You can do this. You could save a good amount and invest for the long term for growth investments. You could do that too. So it's not rocket science. It's achievable for you. So here's your 5 steps. So first of all, it's really useful to get a financial plan. It's the GPS for your life. And basically what a financial plan will do, it'll define what does wealthy mean for you. So let's define what would it be for you to be wealthy. And for a lot of people, when you've got your financial independence goal is kind of like a security thing. That's to live the lifestyle I want. That's how much I need. But it's freedom that you get when you have quite a bit more than that. Okay, so that's really what you're looking for. Your financial plan tells you, once you have it, you know how much you need to save and the return you need to make to get there. Okay, so now you can have a specific strategy. And if you're going to do something for 30 years or 40 years consistently, at the beginning, let's figure out exactly what you need to do. And then, then you could just follow the road all the way along. So now the financial plan also keeps you focused on the long term. I find a lot of people will do something, but then they'll get some crazy idea and they make short-term mistakes, bad investments or some other idea or whatever it is, something that happens short-term in their life, it takes them off their. So financial plan just keeps you focused on the long term. So now that's number 1. Number 2, wealth builds with age. So invest as much as possible when you're young. So just know that it builds over time. So often if you've got a plan and you're working on it and your total isn't that high yet when you're young, that's not really what matters because it builds over time. So then you should save and invest early and benefit from the 40 years of compounding. That's really the big thing. So now, number 4, invest in equities. This is the stock market investments or a business or real estate that has a mortgage and always keeps a larger mortgage. So that's productive growth assets. Invest in those. So, and 5th, borrowing to invest, is into equities is the most effective growth strategy. If done by the right people in the right way over the long term. It's not for everybody, but it works really well if done right over the long term. So in the life cycle investing study is an example of how this can work over many decades. All right, thank you for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's just my name, edrempel.com. I also have a blog, podcast, and YouTube. So the blog is edrempel.com. YouTube is edrempel.com/watch. Podcast is edrempel.com/listen. If you are interested in talking with us about potentially becoming a client or just learning whether, try to find out if it would be or not, we offer a free 30-minute consultation. So it's edrempel.com/talk. Thanks for listening, and we'll talk to you next week.